I think one of the biggest stories of the year is what's been happening in the bond market. The bond market is looking as if it's going to realize its worst year on record, with long-term government bonds down 28% and the broad bond market being down about 16% through October of this year. For an asset class known for its stability, this stock-like volatility is disheartening and making investors rethink this asset class. Fortunately, there's a silver lining to this pain we've seen thus far. Bond yields are the highest they've been in years, and expected returns in the future are now approaching levels closer to their historical average. We think there are several implications to this shift in the bond market for investors to consider. First, for those sitting on large cash positions, they should consider looking at short-term bonds as an alternative. If you don't plan on needing your cash for at least 3 months, you can purchase a U.S. Treasury bill, often considered a risk-free instrument if held to maturity, which is now yielding about 4%. Investors can finally earn a decent return on their short-term cash reserves. With short-term interest rates hovering around zero for the past few years, this is a welcome change. Second, from a longer-term perspective, investors should be revisiting their financial plans. Expected returns on the fixed income side are now higher than they were a year ago. For example, a retiree with $1 million in 10-year Treasury bills was generating about $15,000 of interest income 1 year ago. Today, a retiree with that same amount in 10-year Treasury bills is now generating $40,000 of income. That's a huge increase and something that could change decisions for retirees, especially when determining how much of their portfolio to put in stocks or bonds. Finally, we often find investors who are accelerating their mortgage payments. For those who are taking out mortgages today at 6% interest or more, this can still make a lot of sense. But for those who locked in mortgage rates in the 2 to 3% range the last several years, it may make sense to discontinue accelerating your payments. If you can earn 4 to 5% in a bond, it may be more beneficial to save those extra payments, since the interest you earn would be greater than the interest costs you're bearing. Ultimately, one of the most important investment decisions you can make is how much you should allocate to various asset classes like bonds. With this shift in the bond market in 2022, investors should be reconsidering this decision to determine if any changes should be made. Thanks for watching, and please reach out to us if you have any questions.